Massive indeed. Credit Suisse shares down fractionally this morning. They've been down about 20% over the last month amid a slew of announcements this morning. The big number is $4.7 billion. That's the charge the firm expects to take from the forced unwinding of Archegos Capital Management, which failed to meet the prime brokerage's margin requirements. That is expected to trickle down to the bottom line, causing a nearly $1 billion pre-tax loss during the first quarter, according to the firm. Now, in order to get capital ratios back to their target levels, Credit Suisse is suspending its buyback and cutting its dividend. Several executives are taking the fall amid all of this. The head of investment banking, Brian Chin, will step down to be replaced by Christian Meisner on May 1st. The chief risk and compliance officer, Laura Warner, is departing as well. The firm is launching a set of investigations, one aimed to pinpoint exactly what happened with Archegos, the other focused on another issue, Greensill, the supply chain finance company that collapsed last month. Credit Suisse had to close about $10 billion worth of funds that had purchased notes from Greensill. CEO Thomas Gottstein called the loss in prime services, quote, unacceptable, noting that in combination with the recent issues around supply chain finance funds, the firm has caused, quote, significant concern amongst all stakeholders. Gottstein said in a statement that, quote, serious lessons will be learned from these situations, guys.
Yeah. Leslie, of course, one wonders what those serious lessons will be. I guess that's certainly a key question here. We have so many continued questions about Archegos and exactly what in the world was going on there and what the asset manager who ran that firm was thinking, amassing as much as a 30 or perhaps, it seems inconceivable, 40% economic position in Viacom. But when it comes to Credit Suisse, you know, I wonder, does this raise questions yet again as to whether they're better off just merging with UBS and becoming one giant Swiss bank?
It's a good question. I mean, you have to look at the risk controls that were taken among some of their peers versus what was taken at Credit Suisse. I mean, that's something that a lot of people are talking about, whether or not they had the appropriate internal controls in place. Now, does a change in leadership help that? Does it improve the situation for them? The question remains to be seen. If the new people who, in terms of the risk and compliance, they're going to be there on an interim basis, it's unclear exactly who they will be replacing to a more permanent role. That said, is it something that's kind of emblematic of the culture there? Or is it something that can be tweaked with some new blood in those roles? That I think is something that the various stakeholders, as the CEO is mentioning, will be keenly focused on.
Shepard Smith here. Thanks for watching CNBC on YouTube.